A $10,000 portfolio is not nearly enough to fund your retirement. However, you might be surprised how much dividend income you can get with that amount. If you're looking for a video that will take a look at different scenarios that will provide different levels of income, as well as give you an insight on how much money you need to accumulate in order to become financially independent, then you are watching the right video. Hi! Welcome back to Grayson Finance. In today's video, I'm going to be talking about how much dividend income would you receive with a $10,000 portfolio. There are a lot of investment options that will give you various levels of dividend income. One of the most popular ones that you have probably heard of is S&P 500 Index. The reason why it's so popular is that you are getting access to 500 large companies in the US with a long history of profit and stability. There are a lot of people who want to invest in the S&P 500 because of its very good history of healthy returns. Even Warren Buffett recommends it. By purchasing an ETF or index fund that tracks the S&P 500, you will be receiving a dividend yield of less than 1.5%. You might be wondering why it's kinda low. Well, it's because a lot of the largest holdings are actually technology companies that pay little to no dividend. If you invest $10,000 in this index, you will only be getting $12.50 per month, or just $150 per year in dividends. There's another famous investment you can try. It's the Dow Jones Industrial Age, or just the Dow. Investors commonly refer to this index, as well as the S&P 500, as the market. But this index is only second to S&P 500. While the S&P 500 is made up of the 500 largest US companies, the Dow is made up of only 30, making it the second indicator of how the US economy is doing. Investors purchase a fund that tracks a Dow, and they would receive a dividend of over 1.5%, which makes it slightly higher than the dividend received from the S&P 500. In order to get a higher dividend yield, you can opt to purchase a fund that focuses on providing higher income and less capital appreciation. There are a lot of options you can choose from that hold stocks of stable companies and with a good history of dividends. One option you can choose is the Invesco S&P 500 High Dividend Low Volatility ETF. The dividend yield provided by this one is significantly higher than the overall S&P 500, which is around 4%. This option only holds companies that pay the highest dividends, unlike S&P 500, which holds all 500 companies. Due to this, growth is lower over the long term. Investing your $10,000 in this fund will make you receive $33 per month or $400 per year. There are also high dividend funds that old investors may be attracted to. The primary reason why they are liked by older people is that these kinds of funds, more often than not, give off stability. Performance is better during bear markets and worse during bull markets. This stability, when paired up with regular income, is very much popular among retirees or old people. There's another way that enables you to achieve higher dividends, and that is through selecting a sector or industry-specific fund. This type of fund holds companies in one single sector or industry. One sector can yield greater dividends than others because of the nature of its business. Let's take, for example, the energy sector. This sector has a relatively low price but a high dividend yield. This is because a lot of investors are scared of the volatility due to the economic fluctuations, renewable replacements, as well as regulations in this sector. Another risky investment trust is the Real Estate Investment Trust. They are considered slightly risky. Due to their business structure, the majority of profits are headed toward the shareholders in the form of dividends. Those investors who are willing to do some research as well as purchase sectors that have fallen out of favor are able to achieve high returns. The returns will be in the form of dividends and capital appreciation as the sectors they bought rotate back into favor. If you invest your $10,000 in Vanguard Real Estate ETF or Vanguard Energy ETF, you will be getting $25 per month or $300 per year in income. Another option you can consider is considering individual stocks. But if you are a beginner in investing, most finance experts recommend index funds or ETFs, especially because you don't have a large portfolio. Through this, you will be able to learn your way to market behavior, receive stable returns, and make your portfolio grow without taking so much of a risk. After a while, you might be able to decide that you want to select individual stocks given that you are willing to do some research and take greater risks. If you've ever decided to purchase individual stocks, make sure to take a look at the history of dividend growth. The list of dividend aristocrats is a good place to start, as every aristocrat has a history of an increase in the dividend for 25 continuous years. An example of a dividend aristocrat is AbbVie. Investing in this will make you able to receive $37 per month or $450 per year with a 4.5% dividend yield. With this, you are also going to be receiving any capital appreciation or depreciation depending on what the stock movement is in the future. In addition to that, always make sure to screen those prospects by their fundamentals. Always make sure that they reach your standard of reasonable payout ratios with an ideal range around 50 to 60% or less, positive earnings or other potential metrics. Individual stocks tend to get sold off because of matters such as bad news, earnings miss, or new management. As a wise investor, you need to assess whether or not the situation is serious and make your own decisions regarding the stock price. Considering you are an investor that is far from retirement yet, with your $10,000 investment, consider ignoring dividends entirely. This is because you can actually make much more money in the long run if you invest in growth stocks. Dividend-paying investments, if you look at their history, actually have lower overall returns. Considering that you are young, you should seek more growth than this. Even just a 2% difference in your annual rate of return can make a huge difference in your career. Let's take, for example, if you're 25 years old and investing $10,000 once, with an 8% rate of return. In 40 years, you will have $217. With a 10% rate of return, in 40 years you will be getting $452,000. While this growth of money is very enticing, you need to understand that growth stocks are more volatile sometimes, making it hard to handle for investors that are newbies to market fluctuations. If I have to suggest an option for younger investors, it would be an ETF such as Vanguard's Growth ETF or VUG. This investment option holds large cap growth stocks such as Apple, Amazon, and various big stable names. A growth index will most likely outperform the S&P 500 over the long term. This will be ideal for someone who has many years to go before income gets needed. However, take note that less than 0.5% is the dividend yield for VUG because most holdings will pay little to none in dividends. The reason for this is they reinvest the profits of the business within the business to continue growing at a rapid rate. You will most likely earn only $50 per year with a $10,000 investment in this investment option. Generally, with a given portfolio of $10,000, it's better to ignore dividends entirely and instead focus on growth. Given the return, growth stocks will more likely give you a good amount of money in the future than dividends. This is good, especially when you are getting ready to retire. Never make the mistake of focusing primarily on dividend yield early on in your investing career. Thanks so much for watching. I hope you found this video helpful. Make sure to click like, subscribe, and hit that notification bell to keep you updated on new helpful videos like this one.